A massive percentage of the modern workforce ends their primary workday only to begin exhausting themselves in secondary labor markets. Cultural messaging heavily promotes this active, continuous labor as the reliable path to wealth. The mathematics of exponential capital, however, reveal a highly divergent reality. The active side hustle functions as a linear time trap. In contrast, passive index investing operates as a zero-labor exponential engine. We can audit the exact disparity between these two models by running 2024 tax codes, historical S&P 500 data, and the future value of an annuity formula. The data proves that mastering one highly specific, predictably repetitive mathematical equation yields significantly more capital than any active secondary hustle. The active labor model rests on a single compelling assumption, that dedicating extra hours will generate high-margin supplementary income. According to the 2024 Bankrate Side Hustle Survey, 39% of Americans currently operate a side hustle, yet the median monthly earnings from these ventures sit at exactly $891. This graphic demonstrates the hidden fiscal friction applied to that gross income. Before any profit is realized, ordinary income tax and a mandatory 15.3% self-employment tax strip away a significant percentage of that revenue. Once you compound those specific tax deductions with the operational tools, software subscriptions, and initial startup costs required to run the business, the net take-home pay shrinks drastically. A recent LendingTree study quantifies this attrition, revealing that 44% of side hustlers actually operate at a net financial loss during their entire first year. We then have to factor in the physical time investment. Zapier research establishes that the average side hustler commits an additional 13 hours per week to their secondary venture. By taking a realistic net monthly yield and dividing it by those 52 extra monthly hours of labor, we calculate the true effective hourly wage. When every operational expense and tax penalty is properly factored in, this effective rate frequently drops below the legal minimum wage. For the statistical majority of participants, a side hustle fails to function as an engine of wealth. It operates as a highly taxed, low-yield secondary job. By pivoting away from the active labor model, we can analyze the passive capital model, specifically broad market index funds like the S&P 500. The historical baseline for this specific strategy sits at an average annual return of 10.7% over the past 30 years. This is the future value of an annuity formula. It serves as the primary engineering tool for automated wealth creation. The mechanics rely on three core variables. PMT represents your regular monthly payment, R is the expected annual interest rate, and N is the total number of years the capital remains invested. We can input specific test variables into the equation, a standard $500 monthly payment for the PMT and a slightly conservative 10. This specific calculation relies on monthly compounding. Applying capital regularly every 30 days provides a critical mechanical advantage over standard annual compounding by increasing the frequency of return generation. That $1.13 million represents pure capital expansion. It is achieved without a single hour of active labor required beyond the initial system setup. Gross returns look impressive on paper, but actual wealth accumulation is strictly determined by the net yield retained after taxes. This matrix outlines the discrepancy. On the left, we see the heavily punitive tax environment of the side hustle. Revenue is immediately subjected to ordinary federal tax rates up to 37%, compounded by that 15.3% self-employment tax. On the right side, the index fund capital gains bar experiences minimal structural depletion. Index fund investments held over a year qualify for preferential long-term capital gains rates. Depending entirely on income level, those rates lock in at 0, 15, or 20%. This vast structural difference in the United States tax code is deliberately designed to reward the long-term deployment of capital over the daily exertion of active labor. For a standard middle-class professional, selecting the passive index route automatically secures a 15 to 20 percentage point retention advantage on every dollar earned. The mathematics strongly favor passive capital. This raises an immediate psychological question. Why do 39% of working adults still choose the difficult friction of the hustle? The answer lies in the behavioral requirements of active labor. Maintaining a secondary job requires continuous willpower, rigorous emotional regulation, and constant micro-decision-making. Behavioral economics points to automation as the most effective solution to this problem, a concept heavily advanced by researcher Richard Thaler. Thaler's research isolates a specific metric. When individuals utilize automated savings and investment systems, their overall wealth accumulation increases by over 300% compared to manual savers. The global economic community validated the strict accuracy of these behavioral principles when Thaler was awarded the Nobel Prize. A highly predictable, automated strategy succeeds specifically because it removes human emotion, impulse spending, and daily decision fatigue from the wealth equation. In financial systems, a boring, repetitive process guarantees strict execution. That lack of excitement acts as a mathematical multiplier. To accurately evaluate these two methodologies side by side, we have to apply one final analytical framework, the return on time invested, or ROTI. The fatal structural flaw of the side hustle is the strictly linear relationship between time spent and money earned. Active labor ceases to generate any yield the exact second the physical labor stops. This comparative chart illustrates the contrast. The automated index strategy permanently disconnects wealth generation from physical time constraints. By the 30-year mark, the exponential nature of compound interest creates a massive, mathematically unbridgeable gap in net worth between the two approaches. The optimal path to exponential wealth is not found in the exhaustion of secondary labor. It is achieved by making the correct mathematical decision once, automating the process, and letting time execute the work.